Welcome, and thank you for joining us for today's exclusive webinar on access to capital brought to you by SomerCor. We're excited to have Kimberly Brisky, a seasoned expert in business financing, leading our session this evening. Kimberly has years of experience helping entrepreneurs, small business owners secure their funding and learn more about available resources they need to grow. Today, she'll walk you through everything from traditional loans to alternative funding sources, providing insights on how to navigate your business's financial landscape. Get ready to learn how to unlock new opportunities and take your business to the next level. Thank you for being here, Kimberly. I'll pass it along to you.
Having me, and I'm really glad to be here this evening to chat with you about access to capital options. So again, really the conversation we're going to have tonight is what you need to know before talking to a lender. Next slide, please. So just before we get started here, my name again is Kim Brisky. I'm the Managing Director of Communications at SomerCor. SomerCor is a nonprofit lender, and we're certified by the SBA, Small Business Administration, to originate and service SBA 504 as well as Community Advantage loans. Some of you who are City of Chicago folks also know that we administer the Small Business Improvement Fund, SPIF, and Neighborhood Opportunity Fund grant programs for the City of Chicago. Our organization's mission is just to grow businesses, create jobs, and impactful investment everywhere in every community. I have my contact information up here, and we'll have it up again at the end so that you can follow up with any additional questions. Next slide. So again, the topic today is if you're ready to access capital, but you want to know how do you prepare before applying. This presentation is really a helpful insight into the lending decision from the actual lender's point of view. And it makes you be able to be empowered to access the financing you need whenever you go and talk to a lender. But first, here are the things that you need to know. What do you want to know before you talk to the lender? How do you understand the lending decision? And then understand financing options that are available to you. That's what we'll cover in the next half hour or so. Next slide. So let's jump right in. Before you talk to a lender, here are the key things that you need to know. Number one, know your business. Well, that sounds really simple. Really, no matter how long you've been operating, your business plan can always use a refresh, especially when you're considering taking on a loan. That usually means that you're about to try to add maybe a new revenue stream, add another location. Whenever you're trying to make that change and grow, updating your business plan is key. Number two, know your need. Why do you need the capital? Be able to be specific to show how the money will be used and how it's going to help your business grow and along what timeline. Next, this is always the trickiest one, I think, which is knowing your numbers and documents. I say a lot of people probably are familiar with the 5 C's of credit, which is going to be the character, capacity, capital, collateral, and conditions. But you need to be prepared with the specific personal and business financial documents and be ready to answer questions. Not just have them with you, but be able to speak to them when you're talking to a lender. And then, of course, knowing your options. Why you need the capital directs what type of loan you select. There are lots of different capital options out there, and finding the best fit is really important. Next slide. It's also really key to know that you are not alone in this process. I know that being an entrepreneur, you wear many hats. A lot of times it feels as though you are the only one, and that honestly, when it comes to getting capital for your business, you're dealing with something that is incredibly personal for you, but you don't need to go in alone. And there's a ton of free resources available to help you. Obviously, you're already connected with CTO, but there are a lot of other organizations. Within the city, you have BACP, also the Cook County Small Business Source, the SBA, who we are here on behalf of, Allies for Community Business, SCORE Chicago, WVDC. These are all just some of the examples in Chicagoland. All right, let's keep moving. Next slide. Great. So let's say you are now getting ready to sit down in front of a lender. These are kind of the questions that are going to be running through their minds when they're talking to you about your project. They're going to be asking, what is the business seeking capital for, and how much? And they're going to be thinking is this going to be a logical move for the business at that current moment? And they're going to be looking at things like cash flow analysis, and thinking about this new debt and how that will play with the current debt that you have, as well as any additional economic impact or broader industry issues that maybe are outside of your control. Number two, they're going to think to themselves, has this business demonstrated historic creditworthiness? Is there favorable sales trends and effective cash management? Do you, as the business owner, have good relationships with your suppliers and customers and additional lenders that you already may have? And of course, very importantly, is there sufficient cash to meet the down payment requirement? They're also going to be wanting to know, to what extent is you, as the owner, do you have to be able to provide personal support? Do you have the liquidity to support the business if need be? And are you able to service your existing personal debt obligations with discretionary income left over? Meaning, are you able to actually continue your general needs that you have already on the books with whatever you're making from this business if you're going to take on more debt? Additionally, collateral. Do the assets that you're trying to finance, is that going to provide enough security for the lender? Are you going to need secondary collateral, things like business assets, personal residence, or outside personal guarantees to be able to get this capital? So these are kind of going to be the top line questions that are running through the lender's mind. Next slide, please. But above all, cash flow is king. It's the most important component in a lender's decision on loan approval. What I'm talking about is really comparing cash flow available and required debt service on existing and proposed debt. By this, I mean, do you have the cash flow available to pay off the debts that you currently have, plus take on this new debt? And ideally, a lender likes to see cash flow that's trending upward and a debt service coverage ratio near 1.2 or above. And what do I mean by a debt cover service ratio? What I'm talking about is, again, when you have your current debts plus this new debt that you're taking on, that you're able to, by 1.2 times, cover that with what you have coming in through cash. Next slide, please. But I know that a lot of businesses either have faced difficult times, either, again, because of situations you can't control, maybe the market is changing, maybe the economy is changing, maybe you've had supply chain issues, things like that. And if your cash flow cycle has had some issues and you have to try to figure out a way to kind of get that more on track, I have a couple of mediation suggestions here to really try to help build that up so that you're in a better, stronger position when you go talk to a lender. First things first, discuss payment terms with your current suppliers and vendors. You know, at the end of the day, they would prefer to get paid late rather than not paid at all. And your financial health of your company is really tied to their own financial health. So being able to leverage existing relationships and have an honest conversation really makes sense. I would also go on the flip side, not just to the vendors that you owe, but review the payment agreements you have with existing customers and really consider tightening your collection policies if you need to. Some potential clients may not like a lack of flexibility, but at the same time, what you don't want to have is a lot of outstanding payments on your books when if they actually were there as part of your cash flow, it could really help you take out that extra capital. And honestly, when you are doing that kind of thing, that inherently will raise the quality of your customer. I would also make sure you're being transparent with the lenders that you might already have, as well as this new lender that you might be talking to. Because honestly, similarly, lenders want to get paid rather than not getting paid at all. They don't want to go through a liquidation process. So potentially there's opportunities to work with your lenders to adjust your loan terms or find other options if needed. I would also make sure you're having a really frank conversation to discuss your existing revenue and cash flow conversations with your lender. Sometimes, especially if it's a seasonal business, there are opportunities like credit lines or credit cards or seasonal loans that can help cover sort of the lean times and able to kind of keep a more regulated cash flow for the rest of the year. And I think it's also important to sort of check in on what your cash cushions are, how much do you have in terms of an emergency fund and how long it's going to cover. Next slide. So now that you know kind of what's going on in the back of the lender's mind, let's talk about what you're actually going to show and discuss with them. These are a lot of the basics that you will generally need for a loan package. First, you're going to want to be able to provide 3 years of historic year-end financial statements, so tax returns, account-prepared financials for your business. You're also going to be wanting to provide interim financial statements for the current year. That's going to be dated within 90 days of the loan app. We're going to highlight today a balance sheet, an aging report, and an income statement. Additionally, we want to make sure that you have set a debt schedule showing what the existing company's liabilities are. You're going to want to have forecasted financials for the next 2 years and showing the narrative to support those assumptions. This is really the critical piece when you're talking about why you're taking the capital on. You want to be able to show how you're taking the capital, how this is going to help grow your business, and here's the narrative to support these forecasts. You're going to want both bank statements for company and for your personal, and also be prepared with a personal financial statement. Next slide, please. All right, let's dig into the balance sheet. I think a lot of you probably are familiar with this here on the call, but for your reference, it's really a snapshot of at a specific date and time that shows what the business owes and owns. And it's really to be able to measure how well a company manages its cash and non-cash capital. Assets that are owned by the business and reported from most liquid to least liquid in the owner. So we go from like sort of the cash down to the equipment. I think that your liabilities also have, they're listed from your current liabilities and then down to sort of the long-term liabilities as well, which sort of makes sense. You've got your line term credit, but then you also have maybe a mortgage. And then you also have on here equity, which includes the cumulative profit losses, stock owner interest, things like that. This is really an important snapshot of where your business is, and it's able to show these are the assets I have, these are liabilities I have, and here's the net worth. Next slide, please. So another thing they're going to be wanting to look at is the aging report, and this goes back on your conversations that you have with your customers. And what it really shows is how much is due for a customer, then how long it is days past due. So you can see here that when you actually have sort of the longer that you go, that you have this money outstanding, it becomes honestly more difficult to collect. And bankers want to see that you're having customers that are paying you in a timely manner. You should really make sure that your invoice statements match up well with how you're having your payment schedule with your suppliers. The goal is to avoid a gap in your working capital cash flow cycle, meaning that you're getting your payments in so that you have it to be able to pay out for your vendors what you owe. Next slide, please. The next document we're going to run through real quickly here is your income statement, and that's going to record a company's sales, expenses, and profits. You have a cost of goods sold, and that's going to be direct expenses related to the production behind the service or product. Then you also have things like operating expenses or discretionary outlays. That's going to be things like rent and utilities. In general, fixed expenses are controlled by an outside entity like your rent, and the discretionary expenses are going to be controlled by the business owner. Then we're able to pull from that the net income or earnings, and that includes the ultimate profit made by the company during the stated period. And a positive trend analysis is usually correlated with effective management and leadership, meaning that, more often than not, we're going to see that profit and that continued positive trend when we have somebody who is in the management position, understanding their numbers and staying on top of it. Next slide. Lastly, I wanted to kind of cover the debt schedule ratio here. This is a table that breaks down the company's existing debt. And this really refers back to some of the cash flow conversation that we had earlier. It's really important to know how much your outstanding debt currently is, how much you're going to be owing going forward, and making sure that you can continue to pay this debt along with any new debt that you take on. It's really important to make sure when you're actually talking to a lender They're going to also be wondering, have you taken on a lot of other new debt in the last 12 months? They call that unseasoned debt. And then wanting to make sure, again, are you going to be able to pay what's existing? And if you already have debt, how is that debt collateralized? Because you want to make sure that we're not, we can't be able to use the same piece of collateral to back up these same items. So all mortgage and lines of credit is all going to be considered with the term debt. Next slide. Now, moving away from the business financials for a second, personal financial statement is really important. I think that for a lot of businesses, they sometimes might think that, oh, it's really only the business finance that matters, that my business credit score is the key one. I would say that for all businesses, really until you get to the time that you're maybe McDonald's size, honestly, your personal finance, your personal credit score, those are super important and they're going to be looked at by your lender. So make sure that you're upfront. So really what it's going to be showing is the assets and liabilities here that's going to be held by you, the guarantor of the loan, the owner of the business. And it's going to want to look specifically, do you as the guarantor have capital to contribute towards the down payment? Depending on what that is, you need to be able to have that on hand. Do you own real estate or something else that's a fixed asset like that could be pledged as collateral? They're also going to be just looking to see, do you currently live beyond your means? And is the personal income going to be able to satisfy the debt obligations you're taking on? In summary, are you as the owner a burden or a benefit to the company? This is going to be the key question. Next slide. So we also want to see the projections. When you're talking to your lender, aside from all of the money and sort of the key documents, they want to hear the story. They want to hear about what you're going to do with these finances. So let's talk about the projections or financial forecasts that are used to determine future performance. Lenders, they want to see your detail. They want to see business model. They want to see that you have research on your customer base, but they also want it to be honest. Don't think that over-optimistic projections will instill confidence in your lender. They're going to scrutinize it. They're going to want to know exactly where you're getting these forecasts from. So they're going to want to make sure, are your assumptions for this expected revenue included in the projections? Do the projected expense figures make sense when they are compared with how much you've been spending in the past? Is there a detailed analysis of how the loan will contribute to these figures? Does a third-party industry data support the projections? Meaning, if you're looking into your industry, if they look and say, my business client wants to borrow money for this particular industry, but when I look into the third-party data, this shows that this industry is not really supporting that kind of growth. Being able to make sure that you can explain it clearly, and obviously with a business plan, if you're prepared, really makes a big difference. Next slide. And we kind of talked a little bit about the 5 C's at the beginning. And that really is important to go back to that as well, the character analysis. As I mentioned, that it's not just your business credit, that's not just your business performance, it's also your personal credit, your personal involvement with the business, as well as your personal character analysis. They're going to want to look back into your background and credit history. They're going to look at credit reports, and they're going to want to know, does the business owner pay their existing debt on time? Do they have a history of lawsuits or judgments or difficulty adhering to a loan agreement? Is there any federal or state tax liability? Do they have history of late payments, collections, overdue? Generally, these are not or non-starters immediately, but you want to make sure that you're providing sufficient detail and what corrective course of action or remedies that you're taking. Things like, are you auto-paying your bills? Do you have an IRS payment plan? Proof of resolved judgments? If you have a bankruptcy, do you have the discharge paperwork and a full docket ready available for the lender's review? These are the kind of things that if you don't have the spotless credit history that a bank obviously would love, they know most people don't come in that way. But they want to make sure that you have been taking a look at what challenges you might have and are working to address them. Next slide. So let's dig in a little bit as to sort of some of the potential red flags that they could see as something that could be a character issue that they're going to want to dig it more into. Let's say that you've had multiple or frequent ownership changes, incorrectly prepared financial documents, lack of responsiveness, existing lawsuits or criminal filings, history of negative PR on the business or owner, adverse environmental information, or even something as simple as just rushing the lender, that can have a negative impact as well. Next slide, please. So what do you do if you have these issues that I sort of mentioned on the last slide here? Number one, and most importantly, be upfront with your lender. It's better to keep them fully informed from the start rather than them finding out through their own research, because they will. And I think too, it also shows that you are working toward a resolution. For previously delinquent debt, do you come prepared in there with a set of payment plan and proof of scheduled auto payments to show that you are working to pay that down? For lawsuits, either show that there's already been a judgment or estimate the financial liability as soon as possible and disclose that. Sometimes maybe there's a lawsuit, but there's not going to be a financial liability or a large one, so that's important information to have up front. I think it's really important also to review your credit report before you go in to talk to a lender. There can always be mistakes. Make sure that the reporting is accurate. And if there are any issues, make sure that you are addressing those before you talk to your lender, or if those are still in process, make sure you're upfront to tell the lender that. If needed, and this is incredibly important, hire professionals. Honestly, most of you should already have them. An attorney, an accountant, your insurance person. These are your key team members that you're going to turn to help get yourself on track. It's going to be your accountant and bookkeeper and attorney that you're working with. They're going to be the ones providing you with these financial documents to be able to go in and talk to a lender with. You're going to want to make sure that not only are they providing you the documents that you need, that they're taking the time to go through them with you, and that you will be able to, on your own, explain what you are seeing. If your accountant or bookkeeper is sending you things that either they don't look right to you or they're not taking the time to explain it to you, that's going to be your first priority, is making sure that you have that resource on your side. Next slide, please. So I'm happy to pause here, Sharita, if there are questions before we move on to the types of lending, if you think that makes sense. Otherwise, I can keep going. All right, Sharita, not hearing from you, I will keep going then. Oops, oh, sorry, back one slide, please. Thank you. So digging into the different types of lending that you can see, and it can be available for you as you're seeking capital for your business. First, business credit cards. These are, they're not too dissimilar from a regular credit card, but they are a really nice revolving line of credit with a limit to help you make purchases and access capital, working capital for the small expenses. And it's really important to be able to keep that paid off and in full each cycle. Another option is a line of credit. Banks will make a maximum amount of money available to a business, and you can draw upon these funds as needed and repay them within the agreed upon time frame, which is usually less than a year. And it's a great option, especially if you have sort of a more seasonal, cyclical business, and so there are going to be lean times and active times that you'll be able to access that capital. Then you also have bank loans, especially they're also usually generally called term loans. These are going to be, they vary by the lending institution or the bank that you go to. And the credit box, or how willing a bank is to lend, is dictated by the current economic conditions. Any conventional loan offered would not be insured or guaranteed by the government. And, I think for a bank loan, those are typically going to be things that are over a term, meaning you're sort of buying something bigger that you're going to be okay paying off over a long term period of time. It's different than a working capital loan where you have more expenses that are going to be not fixed assets, and you need to take care of them more quickly, and it's more fluid. Next slide, please. So let's dig in a little bit to some financing options. Obviously, working for SomerCor as an SBA 504 lender, I am partial a little bit to the 504 loan. So I'm going to dig into that first. The 504 loan program is a lending solution for businesses that want to buy fixed assets. So that's going to be commercial real estate, land, equipment, heavy machinery. Really, our focus of this program is to be able to create jobs, community development, and really support minority, women, and veteran-owned businesses. The 504 is different than other loans because it actually functions like a public-private partnership, meaning that you're going to have your down payment. We, on behalf of the SBA, are coming in with a portion, and then a traditional lender like a bank or a credit union comes in with the last piece. Who can use the 504 program? You just have to be a for-profit business with under 20 million in tangible net worth, and your prior 2 years average after-tax income under 6.5 million. For any commercial real estate purchases, you have to be actually occupying that space with your business without a 51%, or if it's a new construction, 60%. So just to recap, these aren't for development projects or really for people who their focus is being a landlord. This is about owner-occupied real estate, you owning your own space, personalizing your own space to operate your business out of. 504 works for quite a few different industries: manufacturing, healthcare, storage, restaurants, childcare, professional services, all of these items and more. Generally, if it's federally legal, we're happy to take a look at and see if it's a viable business. Next slide, please. So why would you consider the 504 as opposed to a conventional loan when you're going to be purchasing commercial real estate? Number one, your interest rate is going to be below market. Typically, our interest rates are lower than the conventional interest rate for our portion of the loan. Right now, we're at, I believe, 6.23%, which is obviously quite a bit lower than other interest rates you're seeing right now. Additionally, less money down. Your down payment for an existing business in a non-special use property, meaning that any other business could be able to personalize that property and make it their own. We're not talking about a gas station, which clearly has to be a gas station, but maybe a manufacturing facility, other things like that. If you are both not a startup and not a special use business, you only have to put 10% down for your loan. That's going to leave you with quite a bit more financing to be able to keep that working capital in your business, and something that typically you would have to just sort of designate to pay off your loan. Instead, you keep it in your business to help it grow. Another really key part of the SBA 504 loan program is that it has long-term financing that's fixed, meaning there's no surprise balloon payments. Borrowers can have an option of 10, 20, or 25-year term loans, and this eliminates the surprise balloon payment and allows for more accurate planning. Next slide, please. Another type of loan that SomerCor offers is called the SBA 7A Community Advantage Loan. This is a loan that, rather than the 504, which actually is from a traditional bank and the SBA working together, this is actually financed directly by us at SomerCor. And we're going to remain your point of contact for the life of the loan. Now, this loan is different than the 504 because it can be used for working capital purposes. That means that it's going to be a little bit more a little more flexible, not fixed assets. Loans range from like $50,000 to $350,000, and that generally has been a gap that has been difficult to be able to finance. Your interest rate is going to be from whatever prime rate is up to maybe another 3 to 4.5%. It makes sense that the interest rates are not going to be as low as they would be with fixed asset financing because you don't have the fixed asset to operate as collateral. And your collateral will be required here, and it's going to be really dependent on your personal finances and anybody who's also and sort of the background there to be able to determine what collateral is required. Also, personal guarantee of all owners with 20% or greater ownership in the business is also needed. As I mentioned before, things you can use it for, again, working capital, things like also even just like acquiring a business. So, a lot of times there's the acquisition of actually buying the book of business or buying sort of the IP, things like that. Purchases of commercial vehicles. At this point, the 504 loan does not support rolling stock. So trucks or vans or things like that, that's what commercial vehicles can be used for here. Next slide. There are also a lot of other SBA products that are out there. These actually are not programs that are offered by SomerCor, but a lot of traditional lenders and banks offer these on behalf of the SBA. There's going to be the traditional 7A program in that it actually the lending limit is quite a bit higher. Then you have cap line of credits. You have an express loan, which is similar to a 7A, but again, it's a larger size, but only capped at $1 million, and surety bonds as well. So there are definitely a lot of options that the SBA offers to help with financing. Next slide. A couple other options for financing that are available that are from nonprofit lenders. A lot of you on here might be familiar with Allies for Community Business. They offer loans between $500,000 and $100,000. And for those loans that are $25,000 and less and below, they also don't do the card credit pull. So there really are opportunities for those of you at the really earliest developmental stages of your business, as well as those who are further along in the process. They have sort of their standards here, which is 9% interest, 2% closing fees. Standard term is 36 months. But the really awesome part about working with Allies is they have free business coaching for everybody that they're working with. And that will really be helpful to you figuring out, okay, this is how much capital I need, this is what I'm using it for, and this is how I can get prepared maybe to move on to your next financing tool to be traditionally lending or lendable, work with the bank, work with us at SomerCor. So they're a great place to start. So you can see here that these are sort of the key things that they look at, but really they want to make sure they want to see your credit, not as much focusing on your credit score, but how well you are actually how well you've managed your debts over the last 2 years. Are you showing that you're being responsible in that way? Next slide, please. Another great nonprofit lender that you can consider reaching out to is Greenwood Archer Capital. They have a focus of doing either like $100,000 for working capital, as well as up to $200,000 for Black-owned businesses seeking to acquire owner-occupied commercial real estate. So obviously, this potentially could work hand in hand with the 504 as well. And I have sort of the small business loan terms up here. The loan term can be up to 84 months, and they have the interest fee between 3 to 6% of the loan. So it really is all about working with Greenwood Archer to find the best product that works for you. Next slide, please. There's also Women's Business Development Center. They have a lot of really interesting products for you. They have direct lending, so is up to 50,000 here. You also have Kiva, which is the really startup, which is a cool platform to be able to do crowdfunding. There also is debt and equity. So let's say that potentially you're at a point where you're looking to find an equity investor in your company. This may be an option to discuss. And so they also have other access to capital opportunities that they're constantly curating. So it's really good to actually have a conversation with them to see if there's a product that is a good fit for you. Next slide, please. So this is sort of our larger team here. We've got some of our loan officers as well as our grant team heads. But I feel like it's great if you can head back to the beginning of the slide with my contact information on it, Sharita, and if you have any questions about the loan, different types of loans that are offered, how to get in touch with any of these resources that we talked about today, I'm a great place to start. I apologize, our website got cut off on there, but it's just www.somercor.com. That's where you're going to find more information about SomerCor and what we can do for your business. And I will pause there to see if there are any questions.
Thank you so much, Kim. Currently, it looks like one of our webinar attendees, one of the poll questions within the comments focused in on the biggest challenge when it comes to securing funding for their business. And one of the comments is where to look and how to apply. Miss Maria on our webinar. So I think if you want to touch a little bit on that, we did touch on it in today's presentation, but
But I appreciate that. I think that what can happen is that we are very blessed in Chicagoland to have a lot of small business resources. But sometimes what happens is there's almost too many, and it's hard to find the right fit for you, and also how to apply. Obviously, there's a lot of financial documents that you have to be comfortable with. So my first recommendation is if you want to access free business coaching, technical assistance coaching, to kind of break down your finances a little bit better and figure out which direction. I would connect with Allies for Community Business. I would connect with SCORE. I would connect with Women's Business Development Center. They all have awesome offices of folks. Oh, and honestly, the Cook County Source, all of them offer, on this page, all of them offer really great resources. Actually, even BACP has things that are a little bit more tied to the city. But honestly, all of these folks, this is where you need to be going. They're going to be able to help you get at least a little more comfortable. What we want to avoid is too many Google searches. And I would just say anything that seems too good to be true probably is. So if it seems like you're going to be able to access capital for, really quickly, and it seems like it's not going to be for very much, make sure you're really reading that fine print. And it does, I would say maybe take a pause and talk to one of the experts at one of these organizations first.
Thank you, Kim. We have Hugh Cooper Sr. on our webinar. He wanted to know, is it possible to come into the office? I know with a lot of things going on with COVID and us going very virtually, I know phone and email has been a better option, but if you want to touch on that, Kimberly.
Yeah, sure, I can. I would say this, maybe let's talk on the phone or a conference call first, and then if it's more in-depth conversation, we can do that. Again, at SomerCor, we don't do the one-on-one business counseling, like looking deeply at your financials if you're at the startup point. I usually sort of, I talk to people as they come in, see where they are ready, and then sort of send it off to the people that are the best equipped to handle that. But feel free to send me an email, and let's have an initial conversation and go from there.
Great. I'm actually just put a few things in the comments as well from this particular presentation. But if you're watching right now, we actually will be recording and rebroadcasting this conversation. So definitely we'll make sure that we reach out to everyone with a rebroadcast link. Kim Brisky's email and phone number is actually scrolling at the bottom of this webinar. And I'm going to go back to her contact slide, so all of our attendees can go ahead and take her information down there. Thank you so much, Kim, for joining us this evening. We really appreciate you. Kim Brisky from SomerCor, everyone, on the conversation of access to business capital. Thank you for joining the City Treasurer's Office, Ms. Brisky.
Absolutely. Good luck, everyone.
Thank you. You have a good night.